So if you understand the trend, but you still don't know where to enter, this is what you're missing. Now, in the last videos, we talked about liquidity and market structure. Now, we're putting it together so you can actually start thinking about entering some trades. So here's the core idea of what liquidity means for entries. So as we know, price doesn't move randomly, it moves towards liquidity. And then often it reverses. So instead of chasing price, you want to wait for price to reach areas where liquidity is likely sitting. So if we pair together liquidity and market structure, then we have a really strong idea of where the market could next be moving towards, which allows us to make our entries. So liquidity is usually found in obvious places. There are so many different levels, but the main ones you should be focusing on are above highs and below lows, or equal highs and equal lows. Like I said, there are so many more, but these are the most obvious, they're the most easy to spot, and they're the ones that you should be mainly focusing on when you're starting out. And the reason these four are most important is because that's where a lot of traders have their stop losses, and that's what the market targets. So, the mistake that a lot of people make is they see price moving up. For example, in this example here, we have liquidity sitting up here on this high. Price is trending, it's accumulating, and then, for example, right here, people would see this pullback and think, you know what, price is going to keep going up. So they would enter along here, have a stop loss, target, whatever, and they would just see price going up and buy. They have no thought about this area of liquidity, which could be an area where price is targeting. Or, vice versa. They'll do the same. They'll see price dropping and they'll enter a short, even if there's no liquidity that's been taken yet. And that is the main thing. It's the most important thing for me in trading. If you want to take a trade, there has to be some form of manipulation at some liquidity area. Now, of course, this isn't always going to happen. In this scenario right here, price sweeps this area of liquidity, comes down, starts trading downwards. It doesn't always happen like this. In this example, price sweeps the liquidity, has a small retracement, keeps going up, and in this scenario, it just means that the true draw on liquidity is somewhere higher. So, instead, you need to think like this. Let price first reach an area of liquidity. Let it take those stops and then look for a reaction. If you don't look for a reaction, if you just enter on a sweep of liquidity, this could happen. You could get caught in a small retracement, but price is ultimately going to shoot the other way because you need confirmation that this is a liquidity sweep and not just price trending towards a high. And that is where the better entries usually come from. So if we go onto our chart, let's try and find an example. Okay, so here, for example, price has come down, and you can see this low, price has come down, it swept this low. As soon as this low doesn't get swept, we don't enter along. We don't do this because we need to know that there is confirmation. And in this scenario, as you can see, we would have been stopped out because price doesn't just hit an area of liquidity and keep moving. It's not how the market works. As you can see, the true draw on liquidity is down here. So price comes down here. You can wait for, your break of structure, whatever it may be, whatever your entry model is. And when you confirm that the market has swept this, it's given you a reaction, that is where you should be buying, and that is where the better opportunities with the better risk to the reward, the better win rate, everything comes from the confirmation that this was in fact a liquidity sweep. So, up here, there's a high, price comes up, sweeps this high, we get a confirmation on this candle that it was in fact a liquidity sweep. We've had a break of structure, so you can place, your trade, target whatever, this low, this low, this low, this low, anything. But you can't just short based on the liquidity being swept. In this case, it would have played out, but it's not going to happen like that. You need confirmation, and that's what this break of structure candle here gives us. If you don't wait for that, then this can happen. Price can come down, take out this low, you enter a long, and you get stopped out. You need to wait for a sweep and a break of structure. When you get that, that's when you can look for an entry, look for other areas to target, and that is when you can start forming your own entries. So, never forget, structure and liquidity is the most important thing. If liquidity is taken and structure starts to shift, that's where you get higher probability setups just like this one. So from this video, if you take anything away from it, just let it be, don't chase price. Wait for liquidity to be taken first. Never take an entry without some form of liquidity sweep, even if it's something on a low time frame. Just wait for some form of sweep, some form of manipulation. Then you need to wait for confirmation, wait for a break of structure, wait for an inverse, wait for something to confirm that order flow has been flipped, and then you can start looking for your entry. Now in the next video, we're going to break down fair value gaps and how they fit into this, because now we know when we should be entering, but we need to know how to be entering. And fair value gaps are incredibly powerful if you know how to utilize them, and they're one of the most common ways that traders use entries for. So in the next video, we'll get into that, and that's how you can get those precise entries.